Have we entered gold nirvana? Yes, we have. But it's really been nirvana mainly if you're somebody that owns bullion rather than somebody that owns juniors. You know, it's not, and to be fair, it hasn't been bad for producers. I mean, really what we're all waiting for is when does this food, you know, move down the food chain and we start seeing this really help us when it comes to the juniors. It is arriving, and you know, I would say it has arrived in terms of companies at the producer level. And one thing to keep in mind is Q3 gold prices on average are probably about 10% higher than Q2. And there's been a really big pullback in oil prices. So energy costs should be off, you know, markedly as long as you're dealing with something that doesn't have expensive long-term contracts. So that combination should mean that gold producers, even the laggards really in the last couple of quarters, should be putting up really strong numbers in Q3. So as we get into sort of late October and the producers start giving their guidance and putting out their short form Q3 results, I'm expecting a lot of really big profit increases. We saw that for some of the mid-size. A lot of the mid-size gold companies have actually done really well already, and their share prices have as well. But I think we're going to see even more of that over the next few weeks as the Q3 numbers come out. So I think ultimately the outside money, if you will, we're all waiting for, I think it's going to start filtering in. I mean, I'm starting to see it in a few of the developers that I follow. The ones, you know, basically the ones next step down the food chain closest to production. In a couple of cases, there's been a marked increase in volume in the last week or two. And they, you know, the ones I'm looking at, they don't have, there's no particular news or anything driving that. So I'm assuming that is money that's starting to move down the food chain. It's a long way from the smaller companies and the explorers, but I do think it's going to get there. And you know, to me, the rally that we're in right now, it looks and feels a lot like the April-May version that we saw earlier this year, the one that basically took it from 2,000 to 2,400. And I think it's possible it'll have the same sort of scale. You know, I've been following gold long enough that I'm paranoid about saying something like, I think gold could be $2,800 by the end of the year, but I think gold could be $2,800 by the end of the year. I mean, it feels like the same kind of rally. We just need to see the money start showing up on our side. Now, you know, I'm not a technical analyst. I don't pretend to be. I mean, I look at charts like everybody does, but I don't draw squiggles and lines on them. This is a fairly short-term gold chart. It goes back about a week. You can see the high volatility you see in the middle of it. That was the FOMC meeting and the 50 basis point rate cut announcement. You know, essentially, gold took off and the S&P took off as soon as the announcement was made. But fairly quickly, I think traders started asking themselves, you know, what's JC that makes them want to cut by 50 basis points to 20 instead of 25? So people got a little bit paranoid, sold it down. They sold down SPY too. That didn't last long. Wall Street got optimistic again as soon as the overnight markets opened a couple hours after the New York close. And S&P basically went straight up from there for a couple of days. Gold's more or less done the same. This chart's actually from this morning, but it's up another $5 or $10 from what you see on the right side there. I mean, like I say, I'm not a technical analyst guy, but I look at this chart and this does not look like a chart of an asset that wants to go down. This is a pretty bullish chart. And you look at it longer term, it's just as bullish. I mean, the gold chart looks incredibly bullish. What's driving it? You know, there's four things, I think. One, and this has been going on for a couple of years, is central bank buying. You know, in the past, I hadn't really thought of central bank buying as being, you know, having a significant impact. It was kind of there all the time, but it was just the same all the time. It didn't really make much difference. That's changed in the last 2 years. The amount of central bank buying has gone up substantially, and the number of central banks that are buying has also increased substantially. The reasons for it, I think, are pretty simple. It kicked off when Russia invaded Ukraine for the second time, and all the sanctions were placed against it, and a lot of Russian assets were frozen in New York, some of those assets being Russian central bank assets. That kind of freaked out a lot of central bankers, I think. They didn't like the idea of their U.S. denominated reserve assets, especially ones that were, in custodial holdings in New York, and a lot of stuff. A lot of like European central banks, for instance, they in the past kept a lot of their gold holdings in New York. That was just a convenient place for them to be. You've probably noticed if you watch gold news that a lot of the G7 central banks have actually pulled their gold out of the U.S. because they're worried about, sanctions, from Washington for whatever reason, freezing the stuff. And for the same reason, they've been increasing their gold holdings relative to U.S. dollar holdings, be they U.S. currency or U.S. treasuries. They basically got spooked by those. They got spooked by those sanctions, so they want outside of the U.S. and outside of U.S. dollars assets. Obviously, the other thing that's helped, gold in U.S. dollars obviously trades against the dollar. The U.S. has been, USD has been quite weak this year. There's a chart on the next slide. It's been especially weak in the last 2 months when there was a partial unwind of the yen carry trade. When the carry trade unwinds, the trade you do to unwind your carry trade involves selling U.S. dollars and buying yen. So the U.S. dollar got whacked pretty hard when that happened. The other thing, of course, is falling yields. Yields have been falling all year. We obviously had the rate cut a couple of days ago, but well before that, the market was anticipating rate cuts. The Fed was hinting at them. There were some economic metrics weakening, not that much, but enough to have bond traders decide they wanted bonds rather than equities, so the yields dropped. And the fourth thing is, even though it seems like everybody outside the gold sector is ignoring it, I think there's pretty widespread recognition that gold trades very well during rate cutting cycles. And of course, we just started a rate cutting cycle 2 days ago. So that in and of itself, even without everything else, is a good reason to be on the bid side of the gold market. And like I said, the trend's fairly clear here. You're seeing yields on 10-year yields on the left, U.S. dollar on the right. You can see yields have gone, almost straight down all year. Interestingly, there was a bit of a blip right at the end here. That's actually since the Fed meeting. Even though the Fed cut rates 50 points, when you look at the dot plot's actually the dot plot is just a plot that's put together where every individual FOMC member says, this is where I think rates will be at the end of this year and next year and 2 years from now. And they do this on a lot of different metrics. But the dot plot showed the rates not falling quite as fast as the market was pricing in, and I think that's why you've seen rates come up a little bit. But overall, the trend is down. Same thing goes to U.S. dollar. I mean, not surprisingly, currencies tend to trade with yields, relative yields to each other. So as the Fed keeps cutting and yields keep dropping, that's going to be a downward pressure on the U.S. dollar. It's actually fallen, 5, almost 6% this year, and that's actually a lot for the U.S. dollar to drop. Now, I think most of the good news is probably priced in now when it comes to the U.S. dollar and the yields. I think both are probably going to go lower, but I'm not expecting the same sort of trajectory we had over the last few months. But I don't think it's going to matter as far as the gold market goes. There's enough tailwinds now that even if those two measures don't keep dropping at the same speed, they're still going to support the gold price. They might not drive it, but they'll support it, and that's basically all I'm looking for. And this long-term chart, I put this up. I borrowed it, quote unquote, from Tabby Costa, but there's a bunch of versions of this around. This is the gold price. This is 2-year yields. You can see these portions here where you see these downward arrows. Those are rate cutting cycles. So those are periods where the Fed was cutting rates. And you can see during those same periods, they're highlighted in green, there's fairly strong rallies in the gold price. Not surprisingly, gold trades against yields. So when you've got a rate cutting cycle, it's generally going to be quite positive for gold. One of the most interesting things about this chart to me, honestly, is actually this period in here. Yields, this is COVID, basically yields went to nothing and then ramped really steeply higher as the inflation picked up. But interestingly, it really didn't have that much impact on the gold price. I mean, this is, there's more going on here than just real yields. I mean, I'm a real yield guy. That's what I watch to see where gold's going. But there's a lot more going on than that. There's central bank buying, all the other stuff I mentioned. I mean, basically, this isn't your father's gold market. This market's different. And, I hate, I've never been, and I hate to be one of those guys who starts calling out what I think are ridiculous gold price targets. But this time around, I don't know. I mean, I got a feeling it's going to surprise me, and I think it'll surprise me on the upside. And just to, this is just to reiterate what I mentioned earlier about this is the dot plot. Basically, the purple line, that's what Wall Street thinks interest rates are going to do through this period. The blue line is the actual averages of the dot plot. So you can see, Wall Street was expecting things to fall faster than the FOMC members, and I think that's why you saw yields tick up in the last couple of days. They're just kind of correcting for that difference a little bit. I wouldn't expect rates to go a lot higher because the trend is still down, and Fed's basically talking about 2 more 25 basis point cuts in November and December. And I think there was well, I'll go into some of the reasons in a minute, but tons of gold buying in the gold sector, right? I mean, stocks all went crazy. Well, not really, although I gotta be fair to the gold market. This is basically this year. GDX is up 60%, so it's not like it's traded like crap. Gold is, although it seems like a lot of people in Wall Street haven't noticed, gold is actually the best performing asset class in the world right now. You just wouldn't know it if you asked somebody on Wall Street. But the chart on the right, the chart on GDX it's an ETF. So the chart on the right shows you fund flows weekly, and you can see that really until the last 3 or 4 weeks, and really the last 2 weeks, even as the gold price was rising, it was basically outflows on GDX. I mean, that gives you a pretty good indication of lack of generalist interest, and those generalists are the people we need to really drive things. I think we're all up to our gills with gold stocks, and we're only going to buy so much more. We need some outside money to really drive things. But bottom line is, I've never seen a better setup for the gold market. Even with the move gold has already had, it doesn't get any better than this when it comes to outside factors that affect the market. It's just tailwind after tailwind after tailwind. So I don't really see, I don't see the trend changing. Something might come out of left field, but as things stand right now, the trend's higher, and I don't think that's going to change. The markets were, briefly a little bit spooked, and I was a little bit spooked on Wednesday. I didn't expect the Fed to cut 50 points, and like some people, I was asking, does Jay know something we don't? Is there another shoe to drop? Is there some nasty metric that's going to land in our laps next week? I mean, I don't really think so. I mean, I think that there's a couple of reasons they did 50 basis points. One is that, they arguably should have done it at 25 at the last meeting, and a lot of people thought they would. I think they decided they probably should have as well, and that they were maybe behind the curve a little bit. So they did 50 instead of 25 to just kind of get back on track. The other thing, and I think this might be the bigger reason, there's a fairly long stretch between this Fed meeting and the next one. And between this Fed meeting and the next, there's 2 non-farm payroll reports, and not insignificantly, a U.S. federal election. And I think the FOMC members looked at that and said, you know what, we should probably do 50 just as insurance. If it turns out that employment is weakening as quickly as some people think, and we get a really crappy non-farm payroll report, for instance, we really don't want to be doing a rate cut between meetings, because that will freak Wall Street out. And we really don't want to be doing anything any closer to an election. I mean, arguably they were pretty close already when they did this 50 points. So I think they just went, let's do 50, then we know we don't have to do anything until after the election's over. Even now though, you look at, anybody who follows gold, you look at a gold chart and it's just like, this is awesome, but it's surprising and depressing, I guess, how many people on Wall Street don't realize gold's the best performing asset class this year. I mean, it is. The best performing asset class by far is gold. Hopefully, as time goes on, it's going to start filtering down, and a few people are going to notice. I mean, I don't mind that much that gold's kept its name out of the paper because, you know, frankly, towards the end of a rally, you tend to get a lot of money inflow from outside, and it tends to be the skittish money and the dumb money, frankly. And I'd rather see things move higher at a manageable level and generate some gains for us before the dumb money shows up and really pushes things. So I'm not too worried about that. I do think this money is going to come. The way gold's trading right now, I mean, this week has been, you know, even in a strong gold market, it's been unusually strong this week. I mean, this stuff is going to start getting noticed. You start putting up all-time high after all-time high. You know, even the generalists sort of catch on after a while. So, you know, fingers crossed. But I do think we're still going to see this money start moving down the food chain. And the other thing, you know, that I always follow is discovery stories. They tend to be agnostic about the price of the commodity, that unless the commodity is really doing terribly. As long as the commodity is doing okay, a good discovery story can always generate good gains. So I continue to look for and follow discovery stories because they're going to do well in any market. They'll just do better in a bull market. I don't want to, you know, I pretty much used up my time. I was planning to pretty much talk about gold, but I thought I should throw up a copper chart here at the end. I was a little skittish about copper earlier in the year, and what was bothering me was buildup of inventories in China. The Chinese warehouse inventories went up quite rapidly and got quite high earlier this year. Some of that started getting unwound in the middle of the year, and you can see the impact of that in the price. The price has pulled back from 520, got all the way to 420. But, you know, it's spaced out nicely, and it's actually trading pretty well the last couple of weeks. Other base metals look similar, except for nickel, which is a market that's got its own problems. But, you know, basically, I'm still a little worried about China because the Chinese economy looks pretty horrible, and it doesn't look like it's going to get better anytime soon. But it looks like there's enough demand from other parts of the world to keep a base under it. And I think the copper chart speaks to the idea that you know, people are expecting an imminent recession, depression, etc. Might be overplaying things a little bit. I'm not in the recessionistic camp. I just, you know, I can see things are slowing. Obviously, you can tell that things are starting to decelerate, but I'm just not seeing metrics weak enough to lead me to believe there's an imminent or even near-term recession coming. You know, granted, most of the stuff I and everybody else follows are sort of rear-facing metrics rather than forward-looking metrics. There are a couple of things like what's called the SAM rule, which is named after an economist, Claudia Sam. It's based on changes in unemployment over a 3-month period. That rule was triggered last month by the last non-farm payroll number. It hasn't been around that long, but it's been pretty accurate when it comes to predicting starts of recessions. The other thing that's happened over the last couple of weeks is the yield curve is uninverted, and yield curve inversions tend to be predictors of economic slowdowns, including recessions, but they're basically useless when it comes to timing because the inversion period can be anywhere from a few months to years, and in this case it was years. But when it uninverts, and that's because the curve is steepening, and the curve steepens because you start seeing cuts. That going from a deep inversion to zero has historically been a pretty good predictor that there's a recession coming like tomorrow. So those two metrics do make me a little bit nervous, but I recognize the fact that this cycle coming out of COVID is so weird. It's so unlike past ones. The dive was so deep and the pullback to normal was so fast that I don't trust a lot of the readings. I mean, a lot of the readings that are based on percentage changes and the diffusion indexes like the industry surveys of both supplies and manufacturing, ISM, stuff like that. It's just things have been so weird that I'm not sure I can 100% trust those. So even though there's a couple of metrics that say, yeah, recession tomorrow, I'm just not seeing it in the broad stuff. So I'm not worried yet that we're going to see a recession right away. So bottom line is, gold market is awesome. I do think the money's coming. I think we're going to get ours eventually. It would be nice if Wall Street actually flattened out a little bit. I think that would help. It's a little bit harder to pull money in when people have got their money in, S&P 500, and it's just racking up new highs every day too. A little flattening there. I don't want to see a giant bear market, but a little flattening or a little pullback in Wall Street for a few weeks would probably help, because I think gold's going to do fine. I think if we get that probably increases the odds and increases the speed at which money moves from there to here. But I do think, I think better times are coming, so hang in there. I think we're going to be okay.